Good morning, everybody. Thank you for attending our webinar, Estate Planning Considerations for Pre-Retirees and Business Owners. Before we jump into the meat of things, just a few housekeeping items. As I think was just said to everybody, everybody's in a listen only mode, so phones and computers are muted. As far as questions, I'll just walk through a little bit of a protocol here. If you're participating on a tablet or a phone, if you tap your screen, there'll be a little section at the bottom, a little pop-up here with a place to ask questions, and you can type your question in there. If you are participating on a computer, up here in the upper right, there'll be a little orange arrow for you to click on. And at that point, it will pull up a screen for you. And there's a section here for questions where you can type your questions in there. There's also a handouts section. And the only handout that we really have, I'll bring up here, which is a little bit of background for myself and for Vance, and any questions that either occur to you after the fact or anything that if we're not able to get to them, please don't hesitate to reach out to either one of us directly. And with that, I'll do a quick introduction. We're happy to have Vance Antonacci with us. Vance is the chair of the Estate Planning Practice Group at McNees Wallace Nurick. And Vance, thanks for participating today.
Yep. Thanks for having me, Brad.
And I'm Brad Newman. I'll be, I guess, the moderator today. I'm a certified financial planner with Roof Advisory Group, a division of Fort Pitt Capital Group. So with that, let's dive into. There are a number of pre-submitted questions that we have, and I think a number of them really circle around gifting. The first one, I'll say, will be more of a gifting to the next generation. An individual asks about specifically gifting a house as well as other assets. And the real thrust of the question is, what are things that I should be thinking about as far as doing that gifting now as a lifetime gift versus doing it at my death?
Sure. There's probably a few things you want to consider. One is you have to balance paying a Pennsylvania inheritance tax on any property you own at death in Pennsylvania that transfers to a child or somebody else, balancing that against the income tax basis increase you get for holding an asset until death. So just like if you buy a stock for $1 and it's worth $10 at death, the $9 built-in gain is eliminated. So the capital gains rates, we'll call it 20%. That's $1.80 in tax avoided. If you owned that $10 of stock, you'd pay a 4.5% to your kids, or 45 cents in inheritance tax. So generally speaking, you want to weigh what I would call tax arbitrage. You'd want to see the difference between, if it's a really built-in gain asset, you may not want to gift it because that basis step up is worth more. With a house in particular, when you sell a house during your lifetime to a third party, you of course can exclude, if you're married, up to $500,000 of gain on the sale. If you also own the house at death, you also get the basis step up. So one of the things with houses in particular, it's very hard to recreate basis and figure out exactly what your cost basis is, because people generally don't track that, over the course of their lives. So if you bought your house for $100,000 and it's worth $300,000 today, and you gave that to your kids, and they turn around and sell it at your death, they're going to have a $200,000 capital gain. So there you're going to pay, $40,000 or plus in capital gains taxes where you could have transferred it for 4.5% of $314,000 of inheritance tax. The other thing too is if you're giving a house away while you're alive, if you're not paying rent to live there, it's very easy for any creditor, which would include, medical assistance or any third party, to say, well, that's a sham. You have an implied right to live there. You never really gave away anything, so we can attack that gift and void it. Now, that's an extreme case and an extreme example. It'd be hard, most typical creditors wouldn't think to do that, but medical assistance, if you need to apply for help, would definitely look into that.
Okay.
So there's I have lots of clients, and they're giving away assets because of the increased gifting exemptions right now. And just so everyone knows, you can give away up to $15,000 per person per year without triggering any kind of reporting obligation to the IRS. If you go over that, you have to file a gift tax return, but every person right now can give away $11.58 million without actually triggering tax. So you could literally give away almost $24 million of property today, not pay a gift tax, and avoid any taxes at death on those assets. Again, you wouldn't get the income tax basis increase at death for holding the property until death. But of course, if you're in that kind of stratosphere of wealth, you're probably more concerned about the estate tax than the income tax consequences.
All right, so it sounds like one of the main things to be thinking about is what's the advantage of getting out from under, taxes that need to be paid at death from an inheritance or an estate tax perspective versus what you're getting out from under with a free step up in basis if they die with the asset.
Right, and one other variable is just sort of, if it's a significant gift, I mean, what are you going to live on? Right? What's your cash flow? Where do you get money to live on? Now, a lot of people today who are phasing into retirement have large IRAs or retirement accounts, so that's sort of the bulk of their wealth. And of course, you can't really give that away while you're alive, or not easily, because if you pull money out of the account, you have to pay the income tax and then make the gift, net of the tax, or pay the tax. You got to pay the income tax. Now, of course, you don't get a basis step up on those investments when you die because they're income tax deferred. But you want to think about how that's, if you have a pot of stocks that produce dividends that you live on, and of your house, and then a retirement account, you just want to see what your mixing bowl of assets is, so you can decide what to give away, knowing that you really can't give away the IRA, or not in an efficient manner. Your house probably isn't an ideal asset to gift because of the tax basis issue, and if you're going to keep living there and not pay rent, so it might, by process of elimination, marketable securities in a non-qualified account are often the candidate, or a vacation property or something that like a family cabin or something that's been in the family for a while.
Yeah. And Vance, by non-qualified, you mean an after-tax account, like a traditional joint investment account or regular investment account, something other than an IRA, 401k, 403b.
That's right. Yep.
Okay. Yeah, Vance, that's a really good point, because anytime we have a conversation with clients about gifting, the very first question is, should you be gifting? Do you have the ability to do that? Right. The old, make sure when you're on the airplane, when the masks come down, put your mask on first. So then you can take care of other people. Right. And just along those lines, Vance, the one thing that we talk an awful lot with folks about is with that IRA, really looking at, tax situations for you, the person doing the gifting, and then all of your children, to say, depending on what each individual's, income is, it's going to make sense to try to gift or direct different assets to different beneficiaries. Do you want to touch on that a little bit?
Well, sure. I mean, if you have children who are fortunate enough to be in a higher income tax bracket, You may not want to give the income producing assets to them because you're just going to further compound their tax situation, and they really don't need the money. So you'd want to assess, sort of part of this pot of stuff you own. It all has different tax attributes, and perhaps one of your children would benefit from a particular type of asset than another. So that's sometimes hard to chew through because you don't always know exactly what your kids make or what they have on necessarily. But you can, if you have, one child who's a neurosurgeon and another child who's a school teacher, for example, you have a pretty good idea that one makes more than the other, and has different, maybe a different income profile.
And Vance, while we're on that subject, there is another question that kind of dovetails into that really talks about large balance IRAs and what they refer to as the stretch IRA going away. So up until people dying on January 1 of 2020, the beneficiaries could spread that income out over their entire lifetimes. Now they're forced to take it all out in 10 years. How is that changing, plans or recommendations?
Well, unfortunately, there's not a whole lot you can do to plan around that. I mean, the rule is the rule. And I think the policy behind it was, people that had IRAs were, trying to find the youngest people possible to give them to, like grandchildren. So if you're a 4 or 5-year-old, you would have had an 80+ year life expectancy. And I don't think that's really what Congress intended to do when they allowed for the beneficiaries to stretch. So now it's 10 years for everyone. One of the things that clients would need to look at is if you had your IRA running through a trust, perhaps you had, the beneficiary had creditor risk issues or just couldn't manage money. There was sort of this magical language in your trust agreement that allowed that to happen last year or before. That language has changed a lot, and your document should be updated to account for that. The only real trick we have up our sleeve is you can name a minor beneficiary, and we talked a little bit about this, Brad, before in our prep, is that minors can defer that 10-year payout until they reach the age of 18. So you can still pick a grandchild, for example, a 10 or 12-year-old, and they would get an extra 6 or 8 years in my example, but then they'd still have to pull all the money out within that 10-year time frame. That money can be pulled out and can end up in a trust if that's what you want for different reasons, but the trusts have very punitive income tax rates. So the top marginal income tax rate of current 37% for a trust begins at, I think, $12,950. So the brackets are really compressed. So you really get whacked with income taxes if you keep the money in the trust. Now, if you have a special needs beneficiary or someone who just can't manage money or make good decisions, 63% of something is better than 100% of nothing. So you may just have to do it and bite that bullet. So there are different income tax planning consequences now than there were before. Otherwise, most people that I deal with, just the IRA goes to their kids. They'll have 10 years to pull out the money, and hopefully they'll be smart enough to. It's not 1/10 each year, as you know, Brad. It's you can wait till the last year to pull the money out. What I would tell people is, probably pull a big chunk out in year 9 or 8, and kind of try to balance out staying within a lower tax bracket as you're pulling the money out, and weighing that against the continued deferred income tax-free growth of the property you're pulling out.
And a lot of that, Vance, can also depend on what the individual situation of each beneficiary is. So if, for example, I inherit a large chunk of IRA dollars today, and I know I'm going to retire in 5, 7, 9 years, and I've got a really high income, it's going to behoove me to wait, longer to do it versus if I'm already retired with a very, modest earned income. Let's say all of my income comes in from, pension, Social Security, and some investment income. It may make sense to spread that more evenly over the 10 years to keep a lower, more consistent tax rate. Is that fair?
It's where, financial professionals like yourself can really add value is sort of analyzing what I would call, I just call it cash flow needs, but where is your money to live on coming from in retirement, and what's the most tax efficient way to source that money?
Yeah. And also going back to what is the character of each beneficiary. That neurosurgeon, you might try to, if you've got the ability to give after-tax investments to them, maybe give more to the school teacher as an example, because there's a lower income tax rate to be paid. And I guess clients might want to think about kind of making even the school teacher whole for the taxes they're going to incur that the neurosurgeon wouldn't incur in that example.
Yeah, you can do that. It's really, every estate plan is a blank slate, as I say. So you can really, try to account for any variables you want to in the plan.
Gotcha. Let's see. Here's another gifting question. Gifting money to a child while they're still alive, just kind of asking, what are the legal parameters, what's allowed? I know you touched on the $15,000 a year. That's probably a great place to start.
Yeah, again, you can, the gifting is, $15,000 per person per year. So a husband and wife could give $30,000 a year to a child and not have any reporting obligation with the IRS. Most people, or people often believe that's the max that you can give. You can give away way more, as I described, if you wanted to. If you're going to make a significant gift, and that's, kind of what significant mean is it's up to you. You may want to consider using a trust, just to protect that gift, that advancement of an inheritance against creditors, whether it's a divorcing spouse or if your child is a medical professional, they always have malpractice concerns. They're in business and they're personally guaranteeing debt. You'd want to keep those gifted assets off the table from a secured creditor. There's lots of considerations. Now, if it's just $15,000 a year, I don't know if I go through all that just to tackle a gift of that size. You can also, consider making gifts, to your grandchildren, of course. You can fund 529 plans for them. 529 plans can be front loaded, as I say, where you can make a gift of $75,000 at once and elect to treat it as if you made it over 5 years. So it doesn't, you can really dump a lot of money into those things when the grandchild or even your child is young and not incur a gifting issue.
Right. And the $15,000 per year, that is stackable. So a husband and wife can give $30,000 a year per each child, each grandchild, any living.
That's right.
Beneficiary.
So.
Yeah. And just real quick, Vance, as far as, gifting stock to a person, do you want to maybe touch on the fact how they inherit your cost basis and your, that might not be an ideal asset to use because you're, maybe, pouring gasoline on a fire as far as adding issues to a problem that may already exist.
So as we discussed, you get carryover basis. So if I bought, IBM for $1 and I give you IBM and it's worth $10, you made a $10 gift. I've made a $10 gift, but you have a $1 cost basis. So you typically, if you're going to be giving, cash is cash, so it has a dollar for dollar basis. If you're gifting marketable securities or real estate, you typically try to identify those things that don't have a bigger built-in gain to minimize that issue of carryover basis.
Okay.
So.
Let's see here. And then another gifting question. Really, this is more, it seems like the individual wants to give a house to an adult child, but wants to make sure that it's protected from either a divorce or some sort of liability judgment. And they're really asking about the use of a trust, I believe, in this scenario. Right.
So you can, again, the basic or universal gifting issues are the same. The loss of the basis step up. If you're going to continue living there, you should pay rent. Do you want to do that? if you make a transfer of real estate into a trust, it's depending on how the trust is structured, it's almost guaranteed to trigger a realty transfer tax in Pennsylvania. So if it's a $300,000 house, it's 2%. You figure, you're going to pay $6,000 in realty transfer tax as well to push it into a trust. But that might be, worth the price to pay if you're worried about protecting it from other creditors. But you got to think about, if the house doesn't produce income, how are taxes, maintenance, and insurance covered?
Mm-hmm.
So every year, the carrying costs, if the trust owns the house, the trust should pay the carrying costs of the real estate. Because if not, if the person who set up the trust, then it's just going to have to keep making additional gifts of cash to cover that. Or the beneficiary of the trust, I guess, could pay rent to cover that. But you got to think about, how you don't think about it when you own the house, but every year a house probably, could cost you $20,000, between taxes, maintenance, and insurance. So that's something, just a practical thing to consider is how to manage that as well.
Yeah, this isn't necessarily a question, but we do see a lot just this thing come up within our client base of, kind of that family property, the place at the shore, the place in the mountains, the place at the lake, and they want to make that a kind of in perpetuity family property. And oftentimes the beneficiaries, the ability to use it rarely matches up with the ability to fund it. So in your example, the neurosurgeon has the ability to fund it. School teacher has the ability to spend all summer there, and there's issues surrounding that.
Yeah, vacation properties are tricky. It's easy to use someone else's house because it doesn't cost anything, right? But like you said, if then the kids are stuck dividing up the carrying costs, and some are more of can afford to pay it, and then you have the conversation about sweat equity. Well, I didn't put in as much money as you, but I was up there cutting the grass all summer long, or I fixed the water heater or whatever. I mean, those are very hard to manage. It takes the right type of family to really be able to handle that. And there are, they can become very complicated legal arrangements and can cause a lot of problems if it's not. Well, you can draft the best legal documents in the world, but if they don't get along and they're not going to adhere to it, it's just going to disintegrate and cause more problems than it's worth. So.
Right. Vance, there is another question. We were kind of talking about the liability. This is more around the asset protection, area. And it's somebody who is entering retirement, not married, no children, and they're really kind of asking about premarital moves to address the risk of, it seems like marrying somebody with less of an asset base or a lower net worth. Obviously, prenuptials, you and I, had talked about as the first thing maybe to come to mind, but.
Yeah, I mean, a prenuptial agreement is the easiest way to tackle that. Not the most romantic conversation to have typically, but if you're older and maybe the other person has already been divorced, that it's not, it's too hard to work through typically. If that's not an option or you don't want to go down that route, I mean, you can create a self-settled trust. I mean, a trust you put property in that then continues to benefit you. Pennsylvania is not a jurisdiction that allows that. So your creditors, including a divorcing spouse, can still get to that property. You would have to go to, I think there's 18 or 19 different states that now allow that, where you can create a trust for your own benefit and creditors can't get to the property. But you have
these are like the Delaware, North Dakota, Alaska trusts that you read about.
Yeah, Alaska, Tennessee, South Dakota, Nevada, Delaware. Those are the usual suspects. Florida doesn't allow it. Trying to think, Wyoming. There's a bunch. I mean, but you end up paying a trustee in that state, because the only way to get avail yourself of that state's law is to have a trustee in that state. That's sort of the hook. You know, it's going to cost you anywhere from, I don't know, $5,000 to $20,000 a year, depending on the trust company and what you're putting into it and what's the, you know, what's involved in managing it. And again, you can't move an IRA. I mean, you can't move a retirement plan into a trust while you're alive. So even if you had the self-settled trust in a jurisdiction that allows it, in the absence of a prenuptial agreement, your spouse, you know, potentially could have a claim to your retirement account if there's a divorce.
Right. And I guess as far as implications of doing some of these things, anytime any of these trusts you're talking about, it's once you make that decision, it's forever. You know, once the money goes in or the asset goes in, it's there. You can't unring that bell.
Right. You can't unring the bell or not very easily. That's for sure.
Okay. Circling back on some of the more traditional gifting, there's a question.
Brad, just the other thing too, without a prenup, even if you did a self-settled trust, you still have an addressed alimony obligation. So if you get divorced in the absence of a prenuptial agreement, there's still going to be you're still going to owe alimony if you're the technically or the financially independent spouse.
Okay.
So just one of them, you know, so as awful as a prenup might be to work through, it addresses things that a trust or pre-planning cannot.
Yeah. And as far as alimony, is that solely based on earned income, or could that be based on you have a very large portfolio that generates X amount of income? Could it be on passive income?
Family law courts are courts of equity, so they look at everything. And even though you've put property into a trust and maybe you're a discretionary beneficiary, depending on the judge you get or the divorce master, they might just say, we know what the deal is. And if you wink at them, they're going to give you money. So we're going to act like you didn't even do it in terms of calculating alimony obligations.
Okay.
And then you get into bottomless pits of litigation over, you know, if I'm the divorcing spouse, can I get the trust agreement? You know, what kind of discovery can I have? Can I subpoena those documents? And then, you know, the trustee, you know, resists that, but the trustee takes its legal fees out of your trust. I mean, you could spend, you know, $100,000 fighting over that, you know, instead of, you know, spending a fraction of that on a prenuptial agreement.
Right. So the bottom line is, even if you're protecting the underlying assets, that doesn't absolve you of potentially having to provide an income stream.
Yeah, you're still married, and if you get divorced, those rules still apply to you. So.
Gotcha. Okay. There was a question kind of going back to the more traditional gifting side. This is more on the charitable side, and really kind of the question, donor advised funds have really grown in popularity over the past, you know, 5-7 years. And, you know, maybe could you talk to a little bit of, you know, when is that appropriate versus a family foundation or a private foundation or something of that nature?
Yeah, DAFs are great. We talked a little about this in our pre-planning, but so it used to be, you know, your only real options for charitable giving were, you know, you create a private foundation for your family, or you, you know, just give outright to an organization. I guess some middle ground might be a community foundation, but you got to set up a fund there. So the donor advised funds are, you know, they allow you, the donor, to, you know, put the property into the fund, and then you have the distribution advisor, or whatever they call it, sort of essentially recommend, you know, where you want a grant to be made. And I mean, honestly, as long as it's a 501c3 that fits the requirements, I've never heard of anybody saying no on the fund side. So it's a great way to sort of have your cake and eat it too. They're very easy to set up. It's just account paperwork, like opening any other account. There's no real legal work involved. A lot of times you'll see them funded with, if someone, you know, sells their business, for example, and has a big gain that year, and just, you know, throws a slug of money in because they get the deduction that year, but then have really forever to decide how to kick the money out to the charities. You contrast that with a private foundation, which, you know, you got to incorporate the entity, file with the IRS, you have an ongoing income tax return. You know, it's a it's a thing, just like your business or anything else you have, and it can be a lot of work. And I'm not saying you don't, that work isn't worth it. Some families will use them to kind of acclimate their kids to being charitable, and being on the board. Sometimes children will be employed by the foundation, although you got to be a little careful in what you pay them. But private foundations, if you're going to do that, I mean, I generally, if you're not talking $1 million or more, it's really not worth the effort, frankly. And even if you are talking $1 million or more, I mean, a donor advised fund can absorb, whatever you want to put into it. So, and can provide some flexibility that perhaps you don't have with a private foundation. In my practice, yeah, go ahead.
I was going to say, Vance, the donor advised funds can also be multi-generational. I mean, when you pass, there will be successor, I'll say, owners or successor grantors that people can create a stockpile of funds for kids to donate, that they don't have to dip into their earned income.
That's right. Yeah, and you can kind of run it. I mean, the people say, well, I don't use a private foundation, and the kids are on the board, it acclimates them to gifting. Well, you can kind of act like that with a donor advised fund. And what I mean is, every year, instead of having a board meeting, you can have a fund meeting. You just get the family together and say, okay, we have, on 12/31 of last year, we had X, we now have Y. We want to give away this much. What's everyone's proposal? Who's thinking what? Where are your heartstrings being pulled? And it's conceptually, it's the same process. In my practice, you're only seeing private foundations if you have a significant amount you want to use for charitable purposes, but you want to have an operating entity. And what I mean by that is, you think about the Bill and Melinda Gates Foundation. No, I'm not saying on that scale, but same thing. You want to create programs, do your own things, have a staff. I mean, just, run it like a business. It just doesn't make, it's not for profit. And people will do that, but that's also, obviously a lot more effort and work than a donor advised fund.
Yeah, and Vance, maybe along more the lines of the day-to-day, year-to-year gifting that people do you want to maybe chat a little bit about some of the advantages, disadvantages of using, appreciated stock versus, if you're 70 and a half, the gifting of your RMD for the year, or other things you see?
Well, yeah. So with the IRAs, if you're if you're required to take distributions, you can of course elect to move. I think it's up to $100,000 still over to a charity. Not pick it up as income, but that counts against your minimum distribution, and then you don't get a charitable deduction because you didn't pick up any income. But some people who don't need the money or are very charitably inclined will do that just to avoid paying that $20,000 or $30,000 of income tax or whatever it might be.
And Vance, if I could just slip in here real quick,
Sure.
Even though RMDs are waived this year under the CARES Act, you're still able to make that gift to a charity if you're 70 and a half.
Right.
And with the RMD age being moved up to 72, they did not move up the gifting component. So that is still 70 and a half.
Yeah, it's a good point. There's a disconnect there. So you could actually start taking money out and not trigger your RMD obligation going forward. That's a great point. With appreciated stock, I mean, again, if you want to avoid, trigger a capital gain event, you can always give away an appreciated security investment position to a charity. So again, which is a pretty common central Pennsylvania example is, someone's grandfather or father or mother, gave them bank stock back in the 1960s or 70s, right? And they never touched it. It's in
AT&T.
Yeah, or they actually have the physical certificate still, right?
Yeah.
But that bank is now whoever, by mergers, Wells Fargo or Fulton or whoever, and you never touched it. The dividends are reinvested, and you now have a big chunk of highly appreciated stock with almost no cost basis. Again, you can hold on to it until death, pay the inheritance tax, get the basis step up. You can also gift it to the charity, and the charity can sell it. Charities don't pay income tax, so then you can monetize that investment, maybe get away from the concentrated position, which diversification obviously has benefits when you're investing, and do it that way. Highly concentrated, highly appreciated positions are also are optimal for charitable remainder trust, which is another gifting technique.
Gotcha. Yeah, Vance, we've seen a number of situations where clients have chosen to allow certain stock positions to pass at death just because they didn't want to wade into trying to figure out what the cost basis was. It was such a rat's nest of mergers and acquisitions and dividend investment, and they just said, man, we don't even want to try to tackle that.
In 2010 with no, you could elect to not pay the estate tax, and there's actually a website, it may not still be up for it, that tracked the split up of Ma Bell in '83, yes, and all the different pieces that came back together and help you track what shares you'd actually, if you were a Bell shareholder back in '83.
Yeah. So what would you say are some of the more popular, just to kind of maybe wrap up the charitable giving side, the more popular strategies right now in light of all the changes that we've seen?
Well, the donor advised funds are, always a conversation we're having with clients if they're charitably inclined while they're alive. With the charitable remainder, that's another, popular technique because, again, there's lots of clients, and I'm sure you have these concentrated positions or even not concentrated. They have a batch of securities. There's a lot of buy and hold people in central Pennsylvania, which I love, and that's how to do it. But you bought a stock a long time ago, and there's not a lot of cost basis. You can fund the charitable remainder trust while you're alive. You get an income tax deduction the year you fund it, based on the actuarial value of the future interest going to the charity. And I have software that tells me how to do it. I can't do it on my own. Figure that. So I'm a lawyer, not an accountant or a math guy. But then the trust pays you an income stream for a life or a set term of years, and a lot of people like that because it, again, can diversify their portfolio. It can get them out of this cost basis conundrum, get them a fixed income stream back, and then do some good eventually when the money goes to the charity. So you see that quite a bit with clients.
And Vance, how does our current interest rate environment play into that? Does that make it more attractive, less attractive? What what opportunities or as a provider take away?
Well, yeah. So the present value of the future interest of the charitable gift is you use a statutory interest rate. So the lower the rate, which we have low rates right now, definitely affects that calculation. Most people that I deal with, and I'm sure you aren't too. I mean, they want to do good. They're not too concerned about whether they get a deduction of X or a deduction of almost X. I mean, they're not really playing that game too much. And honestly, if you're waiting for interest rates to go up, you might wait a really long time right now in this country. It's going to be a long time.
Any country.
I'm not a prognosticator, but I'm just, you kind of stick your finger up in the wind, and it's just hard to believe rates are going to move substantially anytime soon.
Yeah.
I think about the first house I bought in 2002. I had a 6% mortgage interest rate, and that's more than double what most people see nowadays. So
yeah,
I thought that was fantastic back then. I couldn't believe it, because I wasn't creditworthy.
I doubt that.
Well, fresh out of law school, I didn't have a lot. I didn't have a lot of shekels in the bank account, so but they still gave me a loan. So.
But along the lines of the charitable remainder annuity trust, I will say I think it's important to really kind of look at different options when you consider that, because we did have a situation a few years back where a client was asked to make a more nominal gift to a charity that he was on the board of, but they were really promoting these charitable annuity trust, and I'll just make numbers up, but I think he was being asked to give 25,000. But the charity was only going to get at the end of the day 12 or 15,000, and the income stream it was going to provide to him was really going to be negligible. It wasn't going to make a difference in his day-to-day, month-to-month. And I said, maybe we just consider just giving them the $15,000 that they're going to get anyhow. It quote unquote saves you a little bit of money today, and that income stream you're getting is not going to be noticeable.
Yeah, I mean, I know you're making up the numbers, but on those lower levels, if it's sort of negligible income and it's just a nuisance then to, wait and get the K1 from the trust and put it on your 1040, I mean, that's probably not worth it. But again, that's a good analysis where you say, you look at the future value of the remainder, you can just accelerate it now and keep the difference, and you're kind of in the same spot financially and tax-wise.
Yeah.
But every client situation is different, and that's why we have these different approaches we can take depending on what they want to accomplish.
Yeah. Vance, let's maybe chat a little bit about, with the, coronavirus and all the stimulus. I mean, $2 trillion of stimulus already. We're on track to have I think the debt to GDP ratio is going to be about 106%, kind of World War II era.
Right.
This is a horrible question to ask, but I mean, do you see anything? What things might you see that changing from an estate tax perspective as far as rules, regulations, et cetera?
So, it depends on who gets elected and what the makeup of Congress is. So, it used to be that unless you had, 60 or more senators in the same party, you weren't filibuster proof. And we haven't had that for years. But the rules in this were changed that essentially you can pass tax legislation on a simple majority vote. So, if you see a situation, if Biden gets elected and there's a Democratic Congress, there's going to be changes. Biden has come out and his platform was a little on estate tax, but estate tax doesn't get a lot of attention in platforms typically anyways. But he was saying essentially that he wanted to do away with the basis step of a death. Now, I don't know, and it's not clear whether that means there'll be a deemed sale when someone dies, and they, trigger a capital gain, which is the system in Canada, or if, whoever gets the property just gets a carryover basis, and then when they ultimately sell it, they'll pay the gain. Now, depending, where you're at on the political spectrum, it doesn't matter to me, but that is just going to be tax anarchy, because it is nearly impossible to accurately recreate cost basis in almost any asset other than marketable securities, and even that's hard sometimes, depending on if you've had mergers and things.
Yeah. And
you just think about the situation, like right now, everyone in the country gets a basis step up. So you think of the quote unquote average guy who say is worth $1 million at death, and there's a house in there that again was bought for $100,000 and it's worth $300,000. No federal estate tax because they're nowhere near the exemption limit. But now all of a sudden, when the kids sell that house, they're going to pay, my example, $2,000 for capital gains tax. It is just going to whack all the wrong people with taxes at death. Through a capital gains tax. It's definitely not going to hurt the wealthy or ultra wealthy. I mean, they're used to planning around this stuff and dealing with it. It's going to really hurt, people at the other end of the spectrum. And it's just going to create chaos in trying to report basis. I don't know if that we twice in our history we've had no carryover base or no basis step up, which was 1976 and 2010, and both times it was just hard to deal with, and it just created compliance issues that were not fair to clients. If Trump gets reelected or there's a Republican Congress or Senate, you're probably going to see the status quo continue. I think worst case scenario is the exemption will go back to, where it was in 2010, which would be about, with the inflation adjustment, about $6 million a person or $12 million a couple. So again, it would carve 99.8% of Americans out of the estate tax regime.
Yeah.
Uh,
Which really, in the big
estate
scheme of
tax
things, doesn't raise that much revenue for the U.S. government.
I think I told you, the estate tax on its best year raises about enough money for the government to fund it through about 2 o'clock in the afternoon on one day.
Yeah.
So it's not even a full day's worth of revenue for the government. It's just a political hot potato, based on what your views are. I mean, the bigger thing is what's going to happen with the income tax laws, which, I couldn't even predict. I mean, I think you'll see Biden seems to be set on the floor of, if you make more than $400,000 a year, you'll be about marginal bracket instead of, I think right now it's like 650. Those rates will also increase from 37 to whatever. I think Biden also has said he wants to raise the corporate income tax rate, which, most corporations don't pay the full rate anyways, because if you look at their effective rates, it's often much lower because of depreciation and tax credits and all the other things that are going into the sausage of the income tax code. And, foreign earning, and there's just, there's a lot of holes you can jump through to deal with that if you're a multinational publicly traded company. So it's hard to say. I mean, unpredictability is part of what we deal with sort of year to year. I think, if you have significant wealth, you'd really want to think about this year making a significant gift just to hedge in case things change. Otherwise, there's not a whole lot you can do. If you have assets that produce income, you're just sort of stuck with whatever income tax regime exists in the particular year you're dealing with. But then again, you could be giving assets. If rates really go up, you could think about, do I want to give income producing assets to children who are in lower brackets? Because again, that analysis of basis step up, if we still have one, versus income shifting may be very powerful. And that's the other, if there's no cost basis step up at death, what's the point of holding an asset to death? You're not gonna, I mean, people will be giving stuff away left and right to minimize income tax consequences. So,
and if we see a notable change in the income tax regime, then that circles back to our earlier conversations about really needing to take a hard look at what type of assets do each of your kids inherit. If it could, maybe start to play around, maybe not with the neurosurgeon teacher example, but looking at your income versus kids' income, that may change a little bit of how you apportion out your assets at your death.
That's right, and there could be all kinds of things. I mean, you may see more charitable giving because people want to mitigate income tax, particularly if the standard deduction rules change. A lot of people fall within that $24,000 as a married couple, and then therefore aren't really perhaps giving as much as they normally would because it doesn't help them from a tax perspective, but that may really change. The other big change is whether the state and local the SALT deduction would change. I mean, if Biden gets elected, he's going to owe it to places like New York and New Jersey and California that have income tax rates, and you'll probably see the SALT limit
and huge property taxes.
Yes, state and local taxes, property taxes. They're capped right now at $10,000, which you can deduct. Which if you live in, pick on New Jersey, with the top, I think it's like 11.5 or 12% is the income tax rate. And if you own, a bungalow, in the middle of the state, you're getting your property taxes are, 15 grand a year. So, but Trump's not going to win those states anyway, so he doesn't care. He's not going to win California, New York, and New Jersey, so he's not worried about their votes or if they're happy.
Gotcha. And Vance, just maybe at a broader level, what are some of the, I'll say, kind of core estate planning documents that really everybody should have, or if they already have, update them.
Yeah, I mean, everyone should have a last will and testament, of course. Everyone should have a financial power of attorney, and everyone should probably have a living will or a healthcare directive. And even in the best of times or more normal times, you'd want to be periodically reviewing those just to make sure that who you've appointed, what's a guardian for your kids or a trustee of a trust or the executor of your estate, that those are the people you want to serve in those roles, that your estate is being disposed of in the way you want it to be disposed of, whether it's equally among your children or some other group of people. So in a normal, normally I tell people probably every 3 to 5 years, you probably want to dust it off and just make sure it's where you want it to be. In stranger days like these, I mean, you might want to just brush it off and make sure that it's where you want it to be. I mean, one of the main things we're seeing is with the change in the IRA rules, if you have your IRA running through a trust, you really should change that language in the document to get it current with the current rules.
And are there specific life changes, obviously a marriage, a divorce, a new child, a new grandchild?
Yeah.
What are the life events that really are trigger points?
Well, if a spouse dies, I mean, typically plans are drafted to, you don't know who's going to die first, so it's sort of agnostic, and you may not need to update it. Some people like to update it just to get closure. A divorce, absolutely, you should update your plan, and change your beneficiary appointments, and and a lot of times, one spouse will have an obligation to another spouse for a certain period of time that may need to be incorporated into the estate plan, whether it's alimony or something else. Grandchildren, I mean, if you're a lot of times you have something in your estate plan for grandchildren, I usually just say, all of my grandchildren, born now or after my will, so you don't have to come back in and pay me to add one grandchild and to give them $5,000 or something. It's not really, it's kind of pointless. But anything like that, often sparks, reflection, and, perhaps it's worth paying a visit to your lawyer at that point.
And do you want to touch on the importance of, once somebody does get their estate plan updated, making sure beneficiary designations are in line with the new spirit of the plan?
Yep. So your will doesn't control that. So if you have a 401k or an IRA or life insurance, you need to coordinate those beneficiary designations with your overall plan. So, spouse is primary, kids are contingent. If there's a trust, you want to name the trust as the contingent beneficiary, and that's, I know you guys will help clients work through that once the plan is finalized. It's not automatic. And even if you get divorced, it's not automatic. So if you name your ex-wife or ex-husband as a beneficiary, you got to change that. It doesn't happen automatically. So
yeah. And I know we just, you mentioned trusts a couple times in the last few minutes. There was a question of very, very generically, we had talked about, I think, some specific issues, but they had asked, why would you, create a trust? Would, maybe just a quick laundry list of.
Sure. There's really I'd say 3 circumstances. One is you need to do it for tax avoidance. So you have a large estate, and downstreaming money is just going to create another set of transfer taxes at death. So it's a way to shelter assets from taxes. Situation 2 would be if you have a child who has creditor risks, whether it's a divorcing spouse or a business or a professional, they're a doctor and they're worried about malpractice claims. The trust is a very easy way to shelter those assets from claims of those creditors. Or the third situation would be you just have a beneficiary who just really manage money and make good decisions, whether that's because of a drug addiction or mental health issues, whatever is going on in their life, that they just can't be trusted to not, sort of blow up, make bad decisions with the money.
Yeah. And again, Vance, these you're really talking about when you talk about trust, non-IRA, non-retirement plan assets predominantly, correct?
Yeah, you can still run those through the trust if you need to. They're not ideal because of the income tax consequences, but sometimes you just have to deal with it. But it could be anything anything you have. If you want to protect it for those reasons, that's how you would do it. You would use the trust.
Makes sense. Let me see here. And then I guess just real quick while we're on that, just maybe a recap of those really, really compressed income tax rates on trust that, you know, you might be solving one problem, but creating potentially another problem.
Yeah, so the income in a trust, if it's not distributed to the beneficiary, is essentially taxed at a flat, you know, call it 40% tax rate between Pennsylvania and the federal level. It helps to really kind of push that money out. Now it's to or for the benefit of the beneficiary, so you don't actually have to pay it out to the beneficiary directly. So, for example, if the trust is paying someone's rent and paying their car payment and paying, you know, for their groceries and all that stuff, it counts as a deemed distribution, and the trust gets a deduction. The beneficiary picks up the tax on the income on their side and pays the tax. But you know, let's just say it's $50,000 a year. That's way different at the individual tax level than the trust level. You're saving, you know, 10, 12, I mean, maybe the whole, I mean, $50,000, depending on your circumstance, may not even put you in a tax bracket, depending on what else you have going on. So you're saving a significant amount of money that way.
Okay. So it kind of goes back to the concept of look at it both ways. Look at doing something versus nothing, or A versus B, and really knowing where each scenario is going to place you at the end of the day, and then make decisions from there.
Yeah, I mean, if let's just say, you know, your beneficiary is bipolar, right? And then they can't, you know, just be trusted to make decisions that are going to be beneficial or smart or whatever the situation. I'm not picking up bipolar, whatever the situation is. You can say, I might pay an income tax, but that's better than losing all of it to, you know, what I would believe would be bad decisions that would be made by a person.
Makes sense. Well, Vance, I think we've gotten to everybody's questions today. Is there anything as a wrap up or a parting thought?
No, I mean, other than I think, you know, we've touched on a lot of stuff. It's a lot of complicated stuff. It's why it helps to have, you know, people like you and your team involved to help, you know, as I say, dance through the raindrops or read the spaghetti, you know, to try to figure out what is best for them and plan. I think the main things are, no matter what you want to do, you know, keep reviewing things, even if it's with your financial advisor, just to make sure you feel comfortable with what's going on, you know, and take care of yourself first. I mean, you've worked hard for what you have, and it's important not to put planning objectives ahead of your own financial security, you know. So that's really, you know, I generally encourage people to impoverish themselves. So yeah, it's something I don't advocate for. So I think that's, you know, it's important to have a holistic plan and have your team in place, and again, try to listen to good advice.
Agreed. And you know, we're big believers in, you know, when we get some of these questions, being the first to raise our hand to say, you know, I personally went to 0 days of law school, so there are a lot of things I'm not qualified to chat about.
Yep.
That's when it's time to involve you and your group. And I will just say, again, as I mentioned at the beginning, please don't hesitate to reach out to either of us with questions after the fact. This webinar will be made available as a rebroadcast, and I do believe everybody's going to get that. All the attendees will have that emailed to them directly, so you can go back and re-listen to it at some point. And you know, with that, I would just, you know, like to thank everybody for their attendance. And Vance, thank you again for your participation. And I guess at this point, I'm going to see if I can gracefully figure out how to end this.
Me too. Thank you.
All right. Thanks again, Vance.
Yep.
Okay.